Green bond principles play a vital role in fostering sustainable finance, providing a framework for issuers seeking to align their bonds with environmentally responsible practices. These principles, established by the International Capital Market Association (ICMA), are designed to enhance transparency, consistency, and credibility within the green bond market. By adhering to these principles, issuers can assure investors that the funds raised will be allocated to projects with tangible environmental benefits. Green bonds have emerged as a crucial financial instrument in the global effort to combat climate change and promote sustainability. They offer a means for corporations, municipalities, and governments to finance projects that contribute to environmental conservation, renewable energy, and climate resilience. The green bond principles serve as voluntary guidelines that help define what constitutes a green bond, ensuring that investments genuinely contribute to sustainable outcomes. These principles encompass 4 key components: use of proceeds, process for project evaluation and selection, management of proceeds, and reporting. The use of proceeds is a fundamental aspect of the green bond principles. It requires that funds raised through the issuance of green bonds are exclusively allocated to projects with environmental benefits. These projects may include renewable energy, energy efficiency, pollution prevention, sustainable water management, biodiversity conservation, and climate adaptation. By clearly defining the use of proceeds, issuers provide transparency and enable investors to evaluate the environmental impact of their investments. The process for project evaluation and selection ensures that issuers establish a rigorous framework for assessing and selecting eligible projects. Issuers are expected to outline the environmental objectives of their projects and demonstrate how they align with sustainability goals. This component of the green bond principles encourages the implementation of clear criteria and governance mechanisms to ensure the credibility of green bond issuances. It also enhances investor confidence by demonstrating a commitment to environmental integrity. Effective management of proceeds is essential in maintaining the integrity of green bond financing. Issuers must establish a robust system to track and monitor the allocation of funds to eligible projects. This often involves segregating the proceeds into dedicated accounts and implementing internal controls to prevent misallocation. Transparency in fund management reinforces investor trust and upholds the credibility of the green bond market. Reporting is a critical pillar of the green bond principles, as it ensures accountability and transparency in the allocation and impact of funds. Issuers are encouraged to provide regular updates on the status and progress of financed projects. These reports may include quantitative and qualitative data on environmental benefits, enabling investors to assess the effectiveness of their investments. Independent external reviews and verifications further enhance the reliability of reporting, fostering a culture of transparency within the market. The adoption of green bond principles has significantly contributed to the growth and credibility of the green bond market. These principles provide a standardized approach, enabling issuers and investors to navigate the complexities of sustainable finance with confidence. By adhering to these guidelines, issuers demonstrate their commitment to environmental responsibility and bolster investor interest in sustainable investment opportunities. The global surge in green bond issuance reflects the increasing demand for sustainable financial instruments. Governments and financial institutions worldwide are recognizing the importance of green bonds in achieving climate and sustainability targets. Regulatory frameworks and policies supporting green bond issuance have strengthened the market, encouraging more entities to integrate sustainability into their financial strategies. The role of institutional investors in the green bond market cannot be understated. As sustainability becomes a key consideration in investment decisions, institutional investors such as pension funds, insurance companies, and asset managers are increasingly allocating capital to green bonds. This shift in investment priorities underscores the financial sector's commitment to addressing climate-related risks and fostering long-term sustainable development. Challenges persist in the green bond market, despite its remarkable growth. Ensuring consistency in green bond classifications and preventing greenwashing remain critical concerns. Greenwashing occurs when bonds are falsely marketed as environmentally beneficial, leading to a dilution of trust in the market. Strengthening verification processes and third-party assessments can mitigate these risks and uphold the credibility of green bonds. The future of the green bond market appears promising, with ongoing innovation and regulatory advancements shaping its trajectory. The development of sustainability-linked bonds and climate transition bonds reflects the market's evolution towards greater inclusivity and impact. As financial markets continue to embrace sustainability, green bonds will play an instrumental role in channeling capital towards projects that mitigate climate change and enhance environmental resilience. Green bond principles remain at the heart of sustainable finance, offering a structured approach to mobilizing capital for environmental projects. Their significance extends beyond financial markets, influencing corporate strategies, public policy, and global sustainability efforts. By fostering transparency, credibility, and investor confidence, these principles will continue to drive the expansion of the green bond market, contributing to a more sustainable and resilient future.